Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of investing in corporate bonds. A smart way to earn steady returns. Investing can be tricky, but one of the safest bets is corporate bonds. These investment vehicles offer a steady stream of income and can be a reliable part of your portfolio. But what exactly are corporate bonds, and why should you consider them? Corporate bonds are debt securities issued by companies to raise capital. When you invest in these bonds, you're essentially lending money to the company in return for periodic interest payments. At maturity, the company repays the principal amount. This setup not only provides regular income but also a relatively low-risk investment option compared to stocks. In this video, we'll cover the basics of corporate bonds, their benefits, potential risks, and strategies to consider. Whether you're a seasoned investor or a newbie, understanding corporate bonds can help you make smarter investment choices. Let's explore how they can fit into your financial plan. What are corporate bonds? Corporate bonds play a crucial role in the investing world, offering a balance between risk and reward. Understanding what they are can help you make informed decisions about including them in your portfolio. Definition and basics. Corporate bonds are debt securities issued by companies. They are a way for businesses to raise money without giving away ownership. When you buy a corporate bond, you are essentially lending money to the company. In return, the company agrees to pay you interest at regular intervals. Once the bond reaches its maturity date, the company returns your initial investment, known as the principal. Here's a more detailed look at their basic principles. Interest payments. These are usually made every 6 months and are a fixed percentage of the bond's face value. The interest rate is also called the coupon rate. Principal repayment. At the end of the bond's term, the company repays the principal amount. This is known as the maturity date. Default risk. Unlike government bonds, corporate bonds carry some risk of default. This means there's a chance the company could fail to make interest payments or repay the principal. Corporate bonds differ from stocks because they do not offer ownership in the company. Instead, they are a loan from the investor to the corporation, providing a more predictable income stream. Types of corporate bonds. Corporate bonds come in various forms, each with its own set of characteristics and risk levels. Here are some of the most common types. Secured bonds. These are backed by specific company assets, such as property or equipment. If the company defaults, these assets can be sold to pay bondholders. Because of this collateral, secured bonds generally have lower interest rates than unsecured bonds. Unsecured bonds, also known as debentures, unsecured bonds are not backed by any specific assets. If the company defaults, bondholders stand in line with other creditors to claim the company's remaining assets. These bonds usually offer higher interest rates to compensate for the increased risk. Convertible bonds. These bonds can be converted into a predetermined number of the company's shares. This feature provides the potential for capital appreciation if the company's stock performs well. However, the interest rate on convertible bonds is often lower because of this added benefit. Callable bonds. Companies can repay these bonds before the maturity date. Callable bonds often come with higher interest rates because of the risk that the bond might be paid off early, especially if interest rates drop and the company can refinance at a lower cost. Understanding the different types of corporate bonds can help you choose the right one for your investment strategy. Each type has its own advantages and disadvantages, so it's important to consider what fits your financial goals and risk tolerance. Why invest in corporate bonds? Potential for higher returns. When compared to government bonds, corporate bonds offer the opportunity for higher returns. Government bonds are often seen as safer, but that safety comes with lower yields. Companies, needing to attract investors, typically offer higher interest rates. This compensates for the increased risk associated with lending to a corporation rather than a government. Imagine two friends. One borrows money from you with a promise to pay you back with minimal interest because they're super reliable. The other friend isn't as reliable but offers to pay you a higher interest rate. That second friend represents corporate bonds. Companies are like this second friend. They are willing to pay a higher return because they need your investment to grow. Diverse options. One of the appealing things about corporate bonds is the variety available. There are different types of corporate bonds like secured, unsecured, convertible, and callable. Each has its own risk and return profile, meaning you can pick what fits best for you. Secured bonds, backed by company assets. Unsecured bonds, higher interest, but no backing by assets. Convertible bonds, can be changed into company stock. Callable bonds, can be repaid by the company before the maturity date. This variety helps you build a diverse investment portfolio. Just like you wouldn't put all your eggs in one basket, you shouldn't invest all your money in one type of bond. By spreading your investments across different types of corporate bonds, you can reduce risk. Income stability. Corporate bonds can provide a steady and predictable income stream, making them attractive, especially if you're looking for regular payments. With most corporate bonds, you receive interest payments twice a year. This scheduled payout can be a nice addition to your income, whether you're still working or enjoying retirement. Think of corporate bonds like a reliable paycheck. Every 6 months, you get a fixed amount of interest. This predictability can be comforting, especially in an uncertain market. Plus, when the bond matures, you get your initial investment back, adding another layer of financial security. In conclusion, corporate bonds offer several compelling benefits: higher potential returns, diverse options for investment, and a stable income stream. Each of these elements can help you build a robust and balanced portfolio. With a mix of corporate bonds, you can achieve both growth and stability, making them a worthwhile consideration for any investor. Risks associated with corporate bonds. Investing in corporate bonds can offer many benefits, but it's crucial to understand the risks involved. Knowing these risks can help you make better investment decisions and manage your portfolio effectively. Here we discuss 3 main risks: credit risk, interest rate risk, and liquidity risk. Credit risk. Credit risk is the possibility that the issuing company might not be able to meet its payment obligations. This means they might fail to pay you the interest or return the principal amount when the bond matures. The company's financial health plays a significant role in this risk. Default. If a company faces financial distress, it may default on its debt. This can result in losing interest payments or not getting your principal back. Credit rating. Bonds come with ratings from agencies like Moody's or Standard & Poor's. A lower rating indicates higher credit risk. Always check the bond's rating before investing. Imagine lending money to a friend who has a history of not paying back loans. The chances of you losing your money are high. Similarly, investing in bonds from companies with poor credit ratings increases the risk of default. Interest rate risk. Interest rate risk refers to the possibility that changes in interest rates will affect the bond's value. When interest rates rise, bond prices usually fall, and vice versa. This is because new bonds are issued with higher interest rates, making older bonds with lower rates less attractive. Bond prices. If you need to sell your bond before it matures, higher interest rates can mean you sell it for less than you paid. Reinvestment risk. If interest rates fall, the interest income you get from your bond may not be as valuable because you can't reinvest it at the same rate. Think about it like this: if you lock in a bond at 3% and rates jump to 5%, your bond isn't as appealing anymore. New investors would rather buy the new bonds with a higher rate. This makes your bond less valuable on the market. Liquidity risk. Liquidity risk involves the ease of buying or selling your bond. Some corporate bonds are not very liquid, meaning it can be challenging to find a buyer when you want to sell. Low liquidity can impact the price and the speed at which you can sell the bond. Market demand. Thin trading volumes can mean few buyers, making it harder to sell your bond without lowering the price. Price impact. In low liquidity markets, selling your bond might require you to reduce the price significantly to attract buyers. Picture this: you own a rare comic book. It might be valuable, but finding the right buyer could be tough. Similarly, with a corporate bond, low liquidity can make selling it quickly at a fair price difficult. Understanding these risks can help you make more informed decisions when investing in corporate bonds. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.